If you're new to investing, or maybe you've been in the markets for a while, you've probably heard people talk about options. Maybe you've even heard stories about traders making thousands or even millions using them. But here's the thing, most people get lost in the complicated terms. So in this video, I'm going to break down the 4 main types of options in plain, simple English. No overcomplicated terms, no textbook definitions, just a clear explanation that makes sense. And more importantly, I'll show you how each one of these can actually make you money. The 4 strategies we're covering today are cash-secured puts, covered calls, short calls, and long calls. Think of this as your starter toolkit, the foundation that helps you understand how options really work. Once you get these down, everything else starts to click. So, let's kick things off with the most straightforward play, the long call. You want to make $1,000 a month in passive income, not from selling courses or flipping NFTs, but from a strategy grounded in the real financial world. Here's the thing, you can do that by mastering something called a long call option. It's not magic, it's not gambling. It's a strategic way to profit when a stock goes up, using a fraction of the money it would normally take to buy those shares outright. Today, I'm going to show you how this works step by step with real examples, clear math, and no fluff. So let's start with the basics. What exactly is a long call option? In simple terms, it's a contract. And that contract gives you the right, but not the obligation, to buy a stock at a set price, known as the strike price, on or before a certain expiration date. You're paying for the possibility of upside without committing to buying the stock today. The key word here is right, not obligation. That distinction is everything. Now, what does that mean in practice? Let's break it down with an example, because that's where all the theory clicks into place. Say there's a stock called ABC Corp, and it's trading at $100. You think it's undervalued and likely to go up in the next few weeks. Instead of spending $10,000 to buy 100 shares outright, you buy a call option that gives you the right to buy 100 shares at $100. Let's say that option costs you $2 per share. Since each option contract controls 100 shares, your total cost is $200. That's your investment. That's also the maximum amount you can lose. Not bad, right? Now imagine ABC shoots up to $120 before the option expires. You have the right to buy it at $100 and immediately sell it at $120. That's a $20 gain per share. Times 100 shares, you've got $2,000. Subtract the $200 you paid, and your profit is $1,800. That's a 9x return on your money. And that's not hypothetical. That kind of outcome happens all the time around earnings season or big product launches. But let's also talk about the flip side, because being realistic is part of being smart. Suppose ABC stays at $100 or even drops. You're not stuck. You're not on the hook to buy anything. Your option just expires worthless, and you lose the $200 you paid. That's it. No margin calls, no debt. Just a calculated risk that didn't pan out. That's why people love long calls. You know the exact risk up front. Okay, but now you're thinking, how does this turn into a steady $1,000 a month? Great question. Here's where strategy kicks in. Let's say you build a system. You focus on trades where you risk $200 to $300, and your win rate is solid, maybe 3 wins out of every 5. When those wins come, they give you a 3x return. So if you win 3 trades, each netting you $600, that's $1,800. You lose 2 trades costing you $400. You're still up $1,400 on the month. Now scale that up. Fine-tune your entries. Get better at reading momentum or trading earnings. That's how people turn long calls into consistent income. It's not set it and forget it, but it is leverage, risk-defined, and scalable. If you like this video so far, please like, subscribe, and comment your thoughts. Let's come back to the topic. Now, if you're new to options, the jargon might feel overwhelming. So here's a quick glossary of key terms, explained like I'm talking to a friend. Strike price. This is the price at which you can buy the stock, no matter where it trades. Premium. What you pay to buy the option contract. Expiration date. The deadline. After that, the contract is useless. Break-even point. This is the stock price where your gains start to exceed your costs. It's the strike price plus the premium. In the money. The stock price is above your strike. That's good. Out of the money. The stock is still below the strike. You might lose your premium. Let me tie this together with another real-world example. Let's say NVIDIA is trading at $450. You think earnings are going to blow expectations out of the water and the stock will pop. You buy a call option with a $460 strike price, paying $5 in premium, or $500 total. 2 weeks later, NVIDIA jumps to $500. Your option is now worth $40 per share. That's $4,000. Subtract your $500 cost, and your profit is $3,500. Not bad for a smart bet backed by research and timing. Let's say NVIDIA stays flat at $450. What this really means is your call is still out of the money, no intrinsic value. And with time running out, the value of your option starts decaying fast. It's now nearly worthless. You're down your $500 premium. You didn't lose more than you invested, but that's still a full loss on the trade. Now picture the stock drops to $420. Tough break, right? Your $460 call is now deep out of the money. It expires worthless. Again, your loss is capped at $500, the price of the option. But emotionally, it might sting more than that. Don't get too excited. Understand this. Long calls are powerful, but not magic. You can lose money just as easily if you chase hype, ignore earnings dates, or misunderstand volatility. But if you treat it like a business, if you plan your entries, control your risk, and learn from each trade, it becomes a high-leverage tool that works in your favor. So let's zoom out. What does this all mean? It means you don't need $10,000 to bet on a stock you believe in. You don't need to buy 100 shares just to benefit from a move. With a long call, you rent the upside. You lock in a small cost and give yourself a shot at big gains. More importantly, you stay in control. Your risk is capped. Your profit potential depends on your research and your timing. You can instantly start generating $50,000 to $5,000 in passive income per month, and with enough capital and discipline, even $10,000. I'm going to show you exactly how to do that with cash-secured puts, step by step in plain English. Here's the thing. We'll break down how the strategy works, how much cash you need per contract, how to pick strikes and expirations, and how to manage risk like a pro. I'll walk you through the math behind the income, the real risks you're taking, and the rules I use so you can build a simple, repeatable process. Let's break it down. A cash-secured put is simple. You sell a put option on a stock you're happy to own, and you set aside enough cash to buy 100 shares at the strike price if you're assigned. You get paid a premium upfront, day one. Now, 2 clean outcomes. If the stock finishes at or above your strike at expiration, the option expires worthless and you keep the premium as income. If the stock drops below your strike and you're assigned, you buy the shares at the strike price. Your effective cost is the strike minus the premium you collected. That's your built-in discount. What this really means is you're trading day-to-day price noise for upfront cash flow and a cheaper potential entry into a stock you already wanted. What I mean by that is the market pays you because you're taking on downside risk for a period of time. You're saying, if this stock falls to my strike, I'll buy it. The more the market expects movement, higher implied volatility, the higher the premium you'll collect. But here's the flip side. Higher volatility also means a higher chance the stock actually dips below your strike. There's no free lunch. Your job is to price the risk. Choose strikes and expirations where the premium fairly compensates you for the possibility of assignment. Do that well, and you're not just gambling. You're getting paid to wait on companies you'd be proud to own. Let's take an example. The stock ABC is trading at $100. We sell a 1-month $95 put, a promise to buy 100 shares at $95 if we're assigned, and the market pays us $2.50 per share up front. Because one contract controls 100 shares, $250 cash hits the account immediately. In return, we park $9,500 as collateral. In plain English, we're agreeing to buy at a 5% discount to today's price, and we're getting paid to make that promise. That $250 is our income for the month. On the cash set aside $9,500, that's a 2.63% return for roughly 30 days. If you kept finding the same terms all year, real life rarely does, that pace would annualize to about 31.6%. Our break-even at expiration is $92.50, strike minus premium, which is 7.5% below today's $100. What this really means is the stock can fall a fair bit before this trade turns red. Disproportionate outcomes. If ABC finishes at or above $95, the option expires worthless. We keep the $250, never buy the shares, and the collateral is freed up to redeploy next month. In other words, we got paid for being willing to buy, and the market didn't make us buy. If ABC finishes exactly at $92.50, that's our break-even. Ignoring fees, the trade nets out roughly $0. No win, no loss, just a clean exit. If ABC slides to $85, we're assigned at $95 as promised. Our effective cost basis is $92.50 after the premium, leaving an unrealized loss of $7.50 per share, minus $750 at expiration. What this is telling us is the premium softened the blow by $2.50, but it doesn't erase downside risk. The key is that ownership was part of the plan. From here, we can pivot to the next play, often selling a covered call to start lowering the basis and continue the income cycle. This dart below today's price, so you're trying to buy it cheaper if the stock drops. You chose about 1 month until expiration, which is a good window because options usually lose value faster as time passes. That helps you as the seller. So you get paid now, you have a built-in discount if you're assigned, and the plan stays simple. You want to make more with the same capital? Sure, you can, but you have to take a bigger risk. Take an example, and it moves a lot. We sell a 45-day put with a $110 strike. We collect $5 per share, so $500 up front, and we set aside $11,000 as collateral. That works out to about 4.55% on the cash for roughly a month and a half. If every cycle looked like this, the pace would be around 36.9% per year, but markets rarely line up that neatly. Our break-even at expiration is $105. Reality check. The premium looks large because the stock is volatile. Option sellers get paid more when price swings are likely. Events such as earnings, analyst downgrades, or a weak day for the whole sector can drive the stock to $110 or below. A bigger premium signals a higher chance of assignment and deeper downside. Selling the put means you must buy 100 shares at the strike. Your effective cost equals strike minus premium. Only place the trade if you truly want those shares at that cost and can reserve the cash. Big premiums are payment for risk, not free money. Size carefully. Turn your shares into a paycheck. Make your portfolio a side income stream. With covered calls earning $50,000 to $5,000 per month, even $10,000 with larger positions is possible. I'll guide you step by step from strikes to risk management. Here's the thing. We'll break down how the strategy works, how many shares you need per contract, how to pick strikes and expirations, and how to manage risk like a pro. I'll walk you through the income math, the real risks, and the rules I use so you can build a simple, repeatable process. Let's break it down. A covered call is when you own 100 shares of a stock and sell a call option against those shares. You collect a premium on day one. To clean outcomes, if the stock finishes at or below your strike at expiration, the option expires worthless, and you keep the premium, plus you still own the shares. If the stock rises above your strike, your shares are called away at the strike price. Your effective sale price is strike plus premium. What this really means is you're trading some upside for immediate cash flow and a disciplined exit price. What I mean by this is, the market pays you because you're giving up unlimited upside for a period of time. The more the market expects movement, higher implied volatility, the higher the premium you'll collect. Flip side, higher volatility also means a higher chance you'll be assigned and miss a big rally. Your job is to price the trade, choose strikes and expirations where the premium fairly compensates you for capping upside and for assignment risk. Covered calls let you earn cash from stagnant holdings or from positions you hesitate to sell because you're hoping for a rebound. If you at least own 100 shares, sell a call above today's price and collect premium. If shares stay below the strike, you keep stock and income. Above it, you sell at the strike. Upside is capped, but you lower cost basis, adding discipline. You are simply making your stocks pay rent to stay in your portfolio, and until they are sold, you make money out of them. Let's take an example. Stock ABC trades at $100 and you own 100 shares. You sell a 1-month $105 call for $2. You get $200 up front. Your effective sale price, if called, is $107. $105 strike plus $2 premium. Your downside cushion is the premium, so your break-even at expiration on the combined position is $98. $100 minus $2. Here's how it plays out. If ABC ends above $105, you're assigned, you sell at $105 and keep the $2 premium, $700 total profit. If it ends between $100 and $105, the call expires. You keep the $200 and the shares, and you still have any stock gains up to $5. If it ends below $100, the call expires. You keep the $200, which offsets the first $2 of decline. At $95, you're down $300 overall, $500 stock plus $200 premium. What this is telling us is the premium softens the downside but doesn't remove it. The trade is built for income with a plan for exits, not crash protection. Why this example works. You chose a quality company you're happy to hold, picked a strike above price to target a disciplined sell level, and used 1 month to sit in the theta sweet spot where time decay helps you. If you want to aim for more income with the same shares, you can, but you'll take more risk. Another example. XYZ trades at $120 and you own 100 shares. You sell a 45-day, $130 call for $5.50. That's $550 up front, or 4.6% on your $12,000 of stock value for 45 days. If you could repeat similar terms, which is rarely possible, your effective sale price, if called, is $135.50. Your break-even at expiration is $114.50. Reality check. That fatter premium exists because the stock is jumpy. Earnings, a downgrade, or a sector surge could push through $130 fast, and you'll likely be assigned great realized income, but you might miss a moonshot beyond $135.50. Risk controls that actually matter. Size positions so assignment never hurts. Avoid selling calls right before earnings unless you're okay selling. Mind ex-dividend dates because early assignment can happen. Favor 20 to 35 delta strikes and 20 to 45 days to expiration as a starting framework. Use limit orders and liquid names to avoid slippage. And have rules. Take profits when the option loses 50 to 70% of its value. Roll if tested for a credit when you still want to keep shares, or let assignment happen when your target sale price is hit. Bottom line, covered calls let you get paid now, set a rational exit price, and add a small downside cushion while you hold stocks you believe in. Price the risk, pick your strikes with intent, and run the process consistently, and you can turn long-term holdings into a steady income engine. You see, there's a way to make $1,000 a day even when the market crashes? And even if it doesn't crash, you can still walk away with profits. Hey investors, today we're talking about long puts, one of the simplest, most powerful ways to protect your portfolio and potentially cash in when stocks fall. By the end of this video, you'll know exactly what a long put is, why it works, and how to use it step by step using Microsoft as our example. Let's break it down. A long put is like insurance on a stock you don't even need to own. Here's the thing, you pay a small fee, called the premium, and in return you get the right to sell 100 shares at a fixed price, the strike, before a certain date. If the stock falls below that strike, your put gains value. If it stays flat or goes up, worst case you lose only the premium you paid. No margin calls, no surprise losses. Let's take Microsoft, MSFT, as our example. Suppose Microsoft is trading at $350 today. You buy one MSFT 350 strike put expiring in 1 month for a premium of $5 per share, or $500 total. Now imagine a sudden tech sell-off drives MSFT down to $320. Your put is worth at least $30 per share because you can still sell at $350, so your contract jumps to about $3,000. You subtract your $500 cost and you've pocketed $2,500, all from one. Here's the thing, markets don't slide gently. They crash hard and fast. Think back for a second. In early 2020, the S&P 500 sank about 30% in barely a month. Fast forward to 2022, the Fed slams rates higher and the Nasdaq gives up roughly a third from peak to trough. And the gut punch moment? Meta loses about a quarter of its value in a single day after earnings. Those aren't gentle dips you can wait out. They're sudden air pockets. If you were only holding stocks, you either sold near the bottom or watched your portfolio bleed. Let's break down why that matters for long puts. When the screen goes red and fear spikes, most investors mash the sell button just to stop the pain. And that locks in losses. Emotions hijack the plan, and you end up out of the market right before the rebound. Long puts flip that script. Think of a long put as your crash ticket. You pay a small, known fee up front, and in return you keep the right to sell at a fixed price even if everything's melting. Put it on Microsoft so it's concrete. Before the chaos, MSFT is at $350. You grab a $350 put for $5, so $500 total. That's the most you can lose. Then, the sell-off hits, and MSFT slides to $280. Your put is now worth at least the difference, $70 per share, about $7,000 for the contract. Subtract your $500 cost, and you're up roughly $6,500. While others are dumping shares at $280, you're getting paid because you prepared. What this really means is fear becomes your ally. Crashes come with volatility surges, and that's exactly when long puts can rocket in value. The profits can cushion losses elsewhere, or stand alone as a payday that turns a bad tape into a good day. So the next time headlines scream market crash, you don't have to join the stampede. With a well-timed long put on Microsoft or any volatile name, you can step aside from the damage, or better yet, harvest it. Here's the thing, a long put can turn a small risk into a big payoff. Let's break it down super simply. If Microsoft falls from $350 to $320, about 9%, a put you bought for $500 can be sold for about $3,000. After your cost, that's roughly $2,500 profit, about 500%. If Microsoft doesn't drop and just moves sideways, the most you can lose is the $500 you paid. Small known risk, big possible upside.